Today's video is going to give you 5 common investment terms that you need to know in order to understand what options you have when it comes to investing your money. This is just going to be an overview. I will do additional videos in the future that break down what each and every one of these are in further detail. We're going to cover what is a stock, a bond, a mutual fund, an ETF, and a penny stock. A stock is a portion of a company. So picture a pie. The whole pie is the whole company. And if it's divided into little slivers of pie slices, then each one of those slices is a piece of that company. If you buy one stock, you're buying one piece of that pie. When the company grows, then your slice of the pie is now bigger. And if you were to sell it, you can sell it at a profit. If the company shrinks and does poorly with its sales, then your slice of the pie has gotten smaller, and if you were to sell it, you would have a loss. So that's how you make money or lose money, by buying a stock. It's dependent on what the company does, if they're profitable or not over the long run or the short run. Number 2, what is a bond? A bond is basically a loan. I'm gonna loan out my money in exchange for interest. I expect to get that money back over some time, but with interest. This is where bonds are a little bit less risky because they're like a loan. Instead of owning a piece of a company like you do with a stock, you're just giving the company money with the expectation of getting that money back. With a stock, there's no expectation of getting that money back at all. You just hope that you can sell it at a profit. With bonds, you just want to say, here, I don't need this money right now. You do need it. You're going to give me interest in the meantime while you're using the money. That's going to be my profit, the interest. So with the bond, you give your money out. They give you interest at the end of the term, the agreement. It could be 1 year. It could be 1 month. It could be 10 years. Whatever that term is, at the end of it, you get that money back. If you give them $1,000, at the end of that term, you get your $1,000 back, but along the way, you get interest. So that's a very much more conservative way to invest, because usually the interest that they pay is pretty low, but you get your money back. So it depends on the risk you want to take. Now there's risky bonds and less risky bonds. I'll get into that in another video because these things can all get very deep, but we'll just keep it very high level for right now. Number 3, what's a mutual fund? A mutual fund is a basket of stocks. If you own a mutual fund, you own all the stocks inside that mutual fund, but you don't really have any decisions on which ones those are. The person that does is the money manager. Mutual funds have a money manager that are deciding which stocks are inside this fund. So it could be 5 stocks, it could be 100 or hundreds of stocks. And basically that money manager says, okay, I picked these stocks and I think these stocks are going to do the best over the course of whatever time frame they have in mind. And they expect to perform a certain way based on what they have. It could be a growth mutual fund. It could be a conservative mutual fund. So a growth mutual fund is going to have a lot of growth type of stocks inside of it. A conservative fund may have some bonds, it may have some stocks, it could be a mixture. You do pay a fee that goes towards that money manager who's deciding which stocks that they want to buy and sell. Number 4, what is an ETF? An ETF, known as an exchange traded fund, is similar to a mutual fund in that it's a basket of stocks. But with exchange traded funds, they are designed to mirror an index in most cases. So let's say the S&P 500, for example, which the S&P 500 is 500 stocks. So the whole S&P 500 could be one ETF, and that ETF has every single one of the 500 stocks in it. Versus a mutual fund, they might say, okay, we think 25 of these 500 stocks are going to do better than owning all 500. So we're going to go with these 25 in our mutual fund. The ETF, it's not actively managed by a manager, so there's no picking and choosing. It's just all 500 stocks are inside your ETF. So whatever that index does, you do. Historically, not a lot of money managers outperform these indexes because they just don't have the ability to really, truly, consistently pick winners. So that's why the trend is going towards investing in ETFs, because It's a lower fee. They're very minimal. You can get them for a very low price point compared to a mutual fund, and the performance tends to be very similar. So if you're going to buy a mutual fund, you want to say, is this worth the extra money that you're paying versus an ETF? Both mutual funds and ETFs are great ways to take the decision off of your shoulders in deciding what to invest in. Because if you wanted to buy 500 stocks, you would have to go out and physically buy each one of those. You'd have to pay a trading fee for each one of those, and that could get very costly. Not to mention deciding when to sell, all these decisions are just taken off your back if you get into a mutual fund or ETF. So those are the really good benefits that come along with investing in either of those. Now, the difference that you want to really consider is the cost between the two in comparison to the performance. It's okay to pay a bit more if you're getting really good performance, but if you're not, it's like, why would you pay extra? Number 5, penny stocks. Penny stocks are basically stocks that are trading less than $5. They're very, very risky, like very risky. They're not established companies, basically companies that are getting started that don't have a track record. A lot of them end up going out of business because they just don't get off the ground. So if you do decide to invest in penny stocks, don't expect to go very far with them, because most people will say, oh, I want to get into this penny stock because it's going to be the next Amazon. Well, Amazon was never a penny stock. Apple was never a penny stock. Facebook was never a penny stock. None of the big stocks out there today were ever penny stocks. It just doesn't work that way. So I'll put a link below to an article on what is a penny stock, because understanding this will really help you to avoid some big mistakes. That sums it up for today. Those are 5 terms that you need to know when you're starting investing, because they're your basic options when you're getting started. Stocks, bonds, mutual funds, ETFs, or penny stocks. You can get invested in any of those. You can get invested in all of them. Don't forget to give this video a thumbs up, and let me know in the comments below what other questions you have that I could answer in the future. I will do a video on each one of these to really break it down further if you're interested. Subscribe to this channel so you can see my upcoming videos. Thanks for tuning in. Bye.